Welcome back to Squawk This Morning. President Biden's $3.5 trillion tax plan includes a hike on capital gains tax to 39.6% from prior 20% in order to increase revenue. But our next guest says the proposal may actually do the economy more harm than good. Joining us right now is Joe Lonsdale, founding partner at 8VC and, of course, Palantir's co-founder. And Joe knows where I've come out on this over the years, but he wrote a piece about 2 years ago now, I think, about this issue, and it's probably the most compelling argument I've heard. It's actually a little bit different than some of the sort of standard arguments made around capital gains tax. And I'm hoping, Joey, that you can explain to the audience the idea of the lock-in effect that you think capital gains, an increase in capital gains, creates in terms of the efficiency of money getting to the right places.
Morning, Andrew. Yeah, this is a lot of people right now. They're really focused on how much is it fair for the rich to pay? And there's lots of good arguments that wealthy people should pay more in taxes, but you don't want to break the system when you're doing that. And it's really important that capital, just like people, can move to higher return areas. And when people have extra capital, if you raise the capital gains tax too high, then their incentive is to keep it in existing assets and not move it into new assets. And economists have shown that when you can move capital into new assets, basically, you create higher growth and you can work on new things you could build in the economy. So if you have a rate that's too high, you'd much rather not go to the higher growth area. You'd much rather just keep it where it is. It's great for existing big companies, not nearly as good for the innovation economy.
Joe, what do you say to those out there who say, look, there's so much liquidity, there's so much cash floating around, and that no matter how much money you have, you're always going to want to go to the higher, the higher growth opportunity. And therefore, once everybody's paying the same amount of taxes across the board, it's sort of a level playing field, and actually this issue doesn't matter.
Well, there's a lot of moderate economists on the Democratic side who model these things out. And the CBO is probably one of the most moderate places we have, the Congressional Budget Office. They say that if you put capital gains taxes above 28, 29%, you start to get less revenue. Most moderate groups modeling this say if you raise it to 43% overall, you're actually going to get less government revenue than raising it to 28%. That's not a debated thing among most economists. And so this is the mainstream view where the higher the taxes go above a certain point, the more they destroy economic activity. And the moderate people in the previous presidential administrations on the left would tell them that this administration seems to have kicked those people out. They have a lot of people who believe in MMT and who don't really care what the economic modelers say, which is very frustrating.
So, Joe, what do you think the answer is here? Because I think we both all want the same thing. We want to create a system that can self-perpetuate and create remarkable growth in the country. And we can all talk about trying to take cost out, and we should. But at some point, it also appears that we probably need to create some more revenue. And the question, of course, therefore, is how do you do that?
Especially right now with what we're doing, we need some more revenue. Listen, it's obvious that we should have wealthy people paying more. There's ways you can have wealthy people paying more without being penalized for growth and reallocation of capital. There's progressive consumption taxes. There's, you want to tax things you want to be scarce. There's a lot of unused land near major cities. Tax that, right? There's all sorts of ways. There's all sorts of ways. If you want to tax rich people for using beyond a certain amount of carbon, that'd be fine with me. I think taxes hurt the poor the most. We shouldn't be taxing the poor. But if we're going to be taxing the rich, let's tax the rich in a way that doesn't reduce economic activity. Even China, which is a communist country, only has cap gains of 20% because Deng Xiaoping and others modeled out and realized that's how you get to be a wealthy country, is you reallocate capital well. So let's not give up the lessons of the last 100 years just because we want to go after the rich. Let's go after the rich in smarter ways.
One of the ways that some people want to go after the rich, a specific version of rich, is carried interest, which impacts your business, venture capital, and, of course, impacts the private equity industry. Where do you land on that?
Obviously, I'm biased. I have my own personal biases. The thing about carried interest is that if you were to tax carried interest like short-term income, the incentive would be for everyone in the industry to basically use their own money and to manage less of other people's money. And that would actually be a positive, be like a negative thing overall for up and coming people. For me, it wouldn't really matter. I could just borrow money, use my own money. It would hurt my firm slightly. I think actually private equity plays a positive role in the economy. That's a debate we have to have. I don't think enough people have been willing to step forward and say, here's how private equity, here's how venture capital actually creates jobs, actually creates economic activity.
Can I just ask why that industry or your industry should have a better tax rate than, for example, what I do? I'm not saying what I do is so great either. I'm just suggesting that My income is taxed at ordinary income. Your income, I would argue, should be taxed.
Well, I thought the last tax plan was quite...
By the way, not for the money that you've invested. If you invested your own money, of course that should be taxed at the lower rate to the extent we have lower rates.
I thought the last compromise they made was actually quite good. They pushed it where you had to be investing over the long term. Right now, it's 3 years because you're basically creating wealth in a capital gains-like manner where you're reallocating the wealth the same way you reallocate capital gains. You're reallocating the firm's money based on long-term building in the economy. If you want to make that 3 years, 4, 5, 6, 7 years, I think that could be very reasonable too. I think long-term investing should be incentivized in the economy overall. But if you are creating wealth in a long-term capital gains-like way, that's a very healthy form of building, and it should be taxed in a capital gains-like way. And that's where most of the major economies have come down because of how that works.
Shepard Smith here. Thanks for watching CNBC on YouTube.